to quantitative analysis. Let me ask you a couple questions. Let's say you have $1 billion, and I tell you you can own one company, one investment. Which one would it be and why? How would you, more importantly, how would you figure it out? What process would you go through? Pretty important decision. So you'd look pretty hard at that single company and compare it to others. Now, what if I changed the rules on you and told you you can invest in 10 companies, $100 million each? Do you change the nature that you would make the decision on where to put the money? Maybe the answer is no. Maybe you just want the 10 best companies with the highest growth potential. But maybe you would do that and you would look in the bucket afterwards and find that you put your money into 10 high tech companies. And maybe you should spend some of that on, well, high tech companies tend to move in similar directions. Maybe you want to put some into a pharmaceutical firm, an industrial company, manufacturing, biotech. So the question is, do you change your process to build a better team of investments? The answer is probably yes. And if you do, you need different data for that than you would use if you were just looking at them one at a time in an isolated way. And what if I change the rules again? Told you can invest the billion into whatever you want in whatever chunk size that you want. You can add bonds, cryptocurrency, real estate, money market funds, hedge funds, private equity, venture capital. You see where this is going. The more choices and options we have, the more we need to look at things from a portfolio view rather than an isolated one step at a time. We're not in a vacuum anymore. And also, what if we're doing it for a client that has a very specific goal? You'd have to change your process because maybe one client's goal is a social one. Maybe another client's goal is to reduce risk. Maybe another client's goal is to optimize return. And so instead of doing a fundamental analysis on one particular investment, it's either a constrained analysis or it's a portfolio view. And so what happens is that we need additional tools and metrics that combine all these things. And that's what quantitative analysis does. It uses mathematics and statistics to take a different process and different view to analyze a series of potential choices that we have. So I'm going to go through 4 or 5 examples of situations where quantitative analysis can be helpful. This isn't going to go into a lot of detail. This is just a 10 or 15 minute introduction or so. So first example is an insurance company or a bank. And the quantitative tool that they employ is a concept called duration. So let's say we have a bank. And we know banks, on one side, they get deposits from us. And then they take that money and they loan it out to everybody else. So for deposits, the bank has to pay. And so, if we give our banks our money, they're going to have to pay us, call it 1% interest on our money. Not a lot of money today. Very different from 1980, 1990, but today it's about 1% that the bank pays out. But the bank takes those deposits, lends them out, and charges interest. Car loans, home loans, credit cards, cars, and so on. So let's say they collect on average 4%. That's called an interest rate gap. So banks have to manage that gap. That's sort of their revenue, right? They take in 4% per year and they pay 1%. So the difference of 3% is that interest rate gap. And so that's very sensitive though, because people can pay their loans early, pay them off, they can refinance them. People can pull their money out of the bank at any time. Even if it's locked up in a certificate of deposit, those things tend to be very short term in nature. So banks have a very finicky way about managing that stream. So what they do is they really need to be able to match the frequency of deposits with the frequency of the loans. Let me tell you why. Let's say, for example, the average term of a deposit is 2 years. That means on average, when somebody walks in, they puts money into your bank, that money will be there on average 2 years. Let's say the average loan life is also 2 years. If we lucked out and I'm using this word term fairly loosely, I'm gonna twist it a little bit, and I'm actually gonna whisper in your ear, and I'm gonna say, let's actually not call it a term. Let's call it a duration, okay? Which is sort of like a weighted average maturity, all right? Let's say the weighted average maturity of all their deposits is 2 years, and the weighted average maturity or duration of all their loans is 2 years. If that's the case, then when interest rates change, if they're static, we're good to go. We're collecting 4%, we're paying 1%, the world is happy. I can go home at 4 o'clock and try to get in 9 holes of golf. All right. But that's not the world that we live in. And we know that interest rates change. When interest rates change, that modifies the calculus of both the people who are putting deposits in and the people who we are lending money to. If interest rates go up, then the people we loan money to are going to sit tight, right? They're happy with their 4% loan because somebody else would be charging them 6 because interest rates went up. If interest rates go down, people who we've lent money to might be paying our loans off early. So that's going to change the weighted average term or weighted average duration. Our deposits, in fact, are just the opposite. If interest rates go up and we're stuck paying 1%, people are going to take their money elsewhere if we don't respond in kind. If interest rates decline and we're paying 1%, we choose to continue to do that, then people will keep their money with us. So that means that the deposits and the loans might behave very differently when interest rates change. And the degree to which interest rate changes influence the value of our deposits and loans is measured through duration. And the punchline is, if the duration of our deposits and loans are identical, then this insulates the bank from the risk of interest rates changing. They'll behave in similar ways when interest rates change. If if the duration, let's call it, the duration of our loans is 4 years and the duration of our deposits is 2 years, then the loan values will be twice as sensitive to interest rate changes than our deposits. And if that's the case, and interest rates change, the loans that we have are going to behave very differently than the deposits. So what we need to do if we're helping financial institutions manage their risk, and by the way, this can be the same example is for insurance companies because they take money in, then they pay money, and for pension plans. We need to use this mathematical term called duration that measures the sensitivity of a portfolio to a change in interest rates. Duration is the tool we use. So that's example one. Example two, pension plan. And I just mentioned that we can use duration to help a pension plan manage their risk return metrics. Pension plans have a different goal. Okay, pension plans are focused on potential upside, but tend to overweight the risk because they don't want to lose money because it's people's retirement that we're playing with here. And so, which if I ask you that question, you have $1 billion and you're managing people's retirement, and that's all they've got, would you think differently about how you would analyze a company? For sure. You would analyze their downside risk, for example. But of course, if I want a portfolio, because a portfolio, I might have a diversified portfolio that goes in different directions when the market goes down, then I might not lose as much. I might not gain as much when the market goes up, but if the focus on risk of loss, then what I would do is I'd use a series of data to say, all right, here's where my pension plan is now, given the investments that we're currently at. There's probability weighted scenarios of the pension plan going up in the next 3 to 5 years and the pension plan going down in the next 3 to 5 years. And there's a chance I want to know what this probability is. The way that I've drawn it, it's 50%. That's probably too high. So what I would want to do is recreate my portfolio to minimize the probability of downside risk. And so think about the data that I would need to employ this type of tool. So these risk metrics would require us to take a view on individual prospects, upside and downside, and how those fit together. And if we have a large enough data set, we can create a portfolio to minimize the risk of downside loss. And so we might end up with something that started up here, but if we use our simulations in the right way, we might end up with something like this. So we minimize downside risk. There's a much higher probability of a low positive return. We don't have nearly as high a probability of a home run as we did perhaps before, but the risk of loss is less. So that's an example of a quantitative metric that we can use to employ to evaluate investment opportunities to help pension plans. And we can use this for other tools as well, but that's a client example, a customer example that would use these risk metrics. All right, we're back. Third example. Third example, get my, all right. Third example would be, what if we were putting securities into a mutual fund? If we were putting securities into a mutual fund, how would we collect the right companies to put so that we know that they'll behave well with one another? So 3 example metrics: alpha, beta, and factor risk. So for a mutual fund, let's go down here. Let's say I have company 1, company 2, company 3. And we don't know anything about the companies, but we do know that we've measured the degree to which they're risky compared with an average investment. And let's say company 1 has a risk level of 0.5. In other words, its investment risk is very low. It's half as risky as the average being 1.0. So company 2 has an average level of risk. Think about this as a magnifying glass for risk. So if I have a company that has a risk level of 1.5, that means it's 1.5 times as risky as the overall market. So now I would ask you, all right, which companies belong in the mutual fund and at what weights? Now remember, we don't know the fundamentals of this company at all, and we probably want to go through and take a look at that. But we can figure out what our overall portfolio risk is by merging these firms together. So if I think that the stock market, for example, is going to do pretty well over the next 3 to 5 years, then maybe I want to ramp up the risk of my portfolio because on average, these companies, company three in particular, it performs 1.5 times whatever the market does. So if this is the market performance right here, company three would be 1.5 times that. So it's magnified. And so if I think the market's going to do well, I want a company that's going to do even more well. If I think the market's not going to do well, then I maybe want a company that reduces my risk, that only will go down by half as much. You get the picture. So now when I'm thinking about the riskiness of my overall portfolio, I have another metric that I can use to employ. And this is called a beta. And this is called a stocks beta. There are two other ones that I've listed here. One's called an alpha, which is a risk adjusted measure of performance. So say, for example, company one last year earned 8%. Sorry, that's company two. Company three earned 10%. Which one did better? Now, it looks like a silly question, right? Because company three earned 10% versus company two, 8. I'd rather have the 10. But company three has 50% more risk than company two. So it's got 50% more risk and only 25% higher return, 8 versus 10%. So on a pound for pound basis, company two will have performed better. And that's captured using this metric right here. It's a risk adjusted return. Then the third quant metric I have on here is a factor. So for example, we have betas, and that's a factor. In other words, if the overall market is up 20%, company two is going to be up 20 on average. And that's compared to the overall market. But what if I didn't want a metric that compared to the overall market? So for example, I'm really worried about inflation. So I want a stock that is either more or less sensitive to inflation, depending on which direction I think it's going to be. So I could create a statistical model where inflation is one of the variables that I map. I could create a statistical model that's focused on macroeconomic risk, currency risk, the risk of high-tech companies declining, biotech companies going up. So we can create these models that develop sensitivity factors to variables that we want to understand. So that way, if you're creating an overall mutual fund portfolio and your view is positive on the Middle East and negative on Europe, you can create your portfolio, even if it's in the same industry, of companies that will do well if the Middle East does well and doesn't do well um, if Europe is takes a bearish turn. So that's an example of three different metrics that mutual funds will focus on when they're putting their securities selection together. Last one is a high net worth individual. High net worth individual, they're going to have their own specific goals in mind. So we have to pull whatever tools would be appropriate for that. And then for an individual, we would also add a behavioral component to that. So we'd have a lot more qualitative analytics that would get married to these quant tools. What are you most interested in? What are you worried about? Do you want to leave money to your kids? Do you have a nonprofit that you want to donate to? What's your view on whether or not you want to invest in securities that have large carbon footprints? And so For high net worth individuals, we would combine whatever the appropriate tool would be, and then we'd also add some soft metrics. So that gives us a set of examples to cover the quantitative tools and quantitative metrics. So thinking about it a different way, we have an unlimited set of data that we want to help mine to help us make good decisions about how to put things together.